Retrospective application is applicable in case of change in accounting policy. Now, what is change in accounting policy? If you were using LIFO previously, that is last in first out method. Now, if you're using FIFO, or you want to change to AFCO, it is weighted average. Okay, LIFO we will not take. LIFO is not allowed in IFRS. Now want to change to AFCO. Okay. FIFO is first in, first out. AFCO is average cost. So when you want to change from this method to this method, now onwards, that means you should make the changes in the back years also in such a way that you are using AFCO only for inventory valuation. What are these methods going to do? These methods are going to help you to calculate COGS and closing inventory values or ending inventory values. These methods are going to do that. These FIFO and AFCO are going to help you to calculate this. So let's say FIFO COGS is 10,000. Is 20,000, let's say. AFCO COGS is 10,000. So FIFO COGS is high and the profits would be less. AFCO COGS is less, the profit would be high. So now we are giving retrospective application. That means, let's say my net profit 1 lakh and 1 lakh, it would have been, if I deduct FIFO COGS 20,000, my net profit would be 80. If I deduct 10,000 AFCO COGS, my net profit would be 90. So what I shall be doing is, I know that here, it is reducing my net profit. Here it is, my net profit is high. So every year I have shown 80,000 or a 10,000 less amount of net profit. So if I change from FIFO to AFCO, I need to add the net profit by this 10,000 amount and make it 90,000. Okay, actually, whatever the COGS I was showing, COGS was 20 as per FIFO. Now I'm changing to AFCO. So now onwards, all the backdate COGS I have to change with AFCO COGS, and I have to do necessary correction to net profits. I have to FIFO net profit was 10,000, was lesser by 10,000. It was understated by extra 10,000. You can see my expense was more 10,000, right? My expense was more 10,000. So that reduced my profit by extra 10,000. Okay. But AFCO, that was the old treatment. Now I have to change to AFCO. So I know my net profit would be not understated by extra 10,000. It has to be 90,000, not 80,000 for AFCO. So what I can do, FIFO net profit, I will take, add 10,000 to it. So it will become 90,000. Okay. And this I will be doing in retained earnings account. No other account would be impacted, only retained earnings account. I have to do this necessary changes in the backdate every year. Okay. Let's say this was previous year. Previous to previous year, let's say FIFO net profit was, I calculated it was 60. And AFCO net profit should be 70. So of course, I will add 10,000 in that year in the retained earnings account and make it in such a way, or the changes, after making the changes, it would reflect, or it would show that I was using AFCO method for calculating COGS and ending inventory, and my profit also would come to 70. Okay, which actually has to be for AFCO method. Okay, So I'll add extra 10,000 in the previous to previous year. So this particular adjustment will be only be done in retained earnings account. No other account will be impacted and affected because of this. That is what is called giving retrospective application. Let's say this were for 2 years. Let's say before that, net profit with FIFO it was 50. Let's say 40. Net profit with APCO should be 50. So in retained earnings account, whatever my net profit was, it was 40, right? I'll add 10,000 to this to become 50. It is APCO's net profit. That's it. This is retrospective application. Just give me a second. I'm sending a Kaplan text to all of you. Just open that. Uh, Rishita, hello. Hello. Hello.
Yes, sir.
Can anyone hear me?
Hello.
Yeah, can you share this
Hello.
copy in Zoom?
Yes.
Yeah, can you share the copy in Zoom which I've sent? Because my WhatsApp is not opening up. Can you please share in the Zoom message?
Okay, sir.
Hello. Is it
Yes, sir.
yeah, is it possible to share that in this chat? Because my WhatsApp is not opening. I'm just trying to open it since.
Uh,
Yeah, please send now. I'll open the book and explain a question.
So I accept the screen share request.
Sending, so 1 minute.
Yeah, yeah, yeah. It will be in this chat only, right? Where will I get that?
In this chat only you'll be able to see, so.
Yeah, I'm opening the chat. Okay, it
Sir,
is.
I
I
have
think it
shared the
is.
screen.
It's coming. I think.
Is it coming, sir?
I just sent it.
Okay, okay. Just waiting. This WhatsApp is not opening. That's the only problem. Otherwise, I have so many files on this.
I sent it, so.
Send it. Just a second. But where is the file? Okay, FR text.
You can see it in Zoom chat.
Yeah, yeah, yeah. I'm just saving that file, opening it. 2 minutes. It is getting downloaded maybe.
Shall I share the
No, no,
screen?
no. Came,
No,
came,
no.
came,
No,
came.
okay.
No, no. The book is there.
Yeah.
Yeah. So we'll do a question, basic question. That's the reason why I was like saying that we will do from this. Just read this. Introduction to published accounts. We will do this question. So the following information has been extracted from the books of Piclet for the year. 31st March 2009. What they have given? They have given administrative expenses, interest paid, called up share capital, ordinary shares at the rate of $1, so $200. Like there are three zeros omitted here, so it is $200,000. Cash at bank and in hand is given income tax remaining balance from the previous year. That means they have to pay. Now warranty provision is given. Distribution cost, land and buildings at cost, and accumulated depreciation is also given. Okay. Plant and machinery at cost and accumulated depreciation is given. Retained earnings account is given. Loan, how much they have borrowed is given. This is the rate of interest for that loan. Purchases, sales, inventory, trade payable, receivable, all the information is given, and there's some additional information as well. This is the closing inventory value. They are saying building and plant and machinery are to be depreciated on straight line basis, assuming no scrap value. And they have given the rate of at the following rates on cost. Building 5%, plant and machine 20%. There were no purchases or sales of non-current assets during the year. That's great. Depreciation charges, what they are saying, whatever depreciation you get, of that 60% should go in COGS, cost of sales or cost of goods sold. 20% of the depreciation should go in distribution cost, and rest 20% should go in administrative expenses. Income taxes estimated is this. 10% loan note was issued and is repayable 5 years from that date. They have said year-end provision for warranty claims has been estimated at this month. That means your warranty claim should be 75,000 at the end of the year. Okay. Warranty costs are charged to administrative expenses if at all you are incurring any expense for warranty. Of course, we have seen that our provision which we made for warranty was 90. Now they are saying to maintain it to 75. That means 15,000 has been expended. That we will show in administrative cost. Let's solve this question. First, we'll start with revenue. So revenue is 1300. So first step is revenue. Anyone, whenever they start the question solving, it should be revenue. Piclet company's revenue is 1300. Next step is cost of sales. Basically, cost of sales amount given to us is actually did not give cost of sales amount, but purchases is a part of cost of sales. Okay. Purchases we have to take, opening inventory we have to take. So opening inventory is 150. So we'll do this. This is I'm doing for your understanding. Basically, we should not do in the statement all this. Okay, you can understand, right? Opening inventory 150. I'm writing here. Plus purchases 470. Minus closing inventory. So these three we are going to take, but you have been given one adjustment regarding depreciation. They said whatever depreciation you calculate, 60% of that should go for cost of sales. So let's do the depreciation calculation. We will do a running notes here. There are three assets, right? Land, buildings, plant and machinery. We will take their cost and remove the accumulated depreciation. First of all, land doesn't get depreciated. Land is always appreciated. So land's cost is 1 lakh 10. Building cost is 1 lakh. So we'll take 1 lakh 10 and 1 lakh. Plant and machinery 125. We can take three like with 3 zeros omitted also. It will be better to take in that way, not to get confused. From this, we will remove the accumulated depreciation first. That will give us assets cost, carrying amount. Once we get the carrying amount, we can calculate the depreciation on that carrying amount. Land would never get depreciated. Buildings. $48. Plant and machinery 75. So total assets here are 335. After removing this, 125 and 75. Now on this, we will calculate depreciation. What is the rate of depreciation given? 5% on buildings, 20% on plant and machinery. So 5% on buildings. So you should understand okay, I will just remove this because it will be confusing for you. We are supposed to calculate the current year depreciation. This is straight line method, not diminishing balance. For straight line method, the asset value never changes. It is the same every year. On that, you have to apply the straight line depreciation rate. In diminishing balance method, whatever the depreciation you have calculated till now, that you have to subtract, and on that, after subtracting whatever the carrying amount you get, on that you have to calculate the depreciation. So here straight line 5% of 100 would be 5. 20% of 125 will be how much? 25. So now the carrying amounts we can get. So this amounts will be shown in the balance sheet after after deducting the accumulated depreciation and current year depreciation. Okay. Now these two amounts, when we total, the total depreciation comes to 30. Now this we need to divide amongst the respective accounts, which I told you. Depreciation. In cost of sales, we have to take the depreciation also. What was the criteria given for depreciation? 60%. 30 is the depreciation, right? They have clearly said 60% has to go to cost of sales. So 30, the depreciation what we got, of that 60% has to go to cost of sales. So we'll take that. So add all the figures. It comes to 18. Okay. So 150 plus 470 minus 250 plus 18. So your cost of sales totally is 388. So please calculate everything. I've explained everything. Once if you want to have a look through, you can look. We took all the assets, land, buildings, and plant and machinery. We removed accumulated depreciation for both. We calculated current year depreciation. It's on straight line basis. So asset cost will, whenever you calculate depreciation under straight line method, you have to calculate always on the original cost of the asset, not on the return on value after deducting the accumulated depreciation. So I took 100, I applied the rate 5%. I took 125, I applied the rate 20%. I got the depreciation amounts. Total amount is this. Of this, 60% has to go to cost of sales, which I have done. Gross profit. Then what? Then we have to do take all the administration expenses. So we will take distribution expense. $240. And you know that for what was the adjustment given related to depreciation? Whatever the depreciation I got, 30 of that 20% should go to distribution cost. 20% of 36. So we will get 246. Next, administration expenses. $170. %20 of depreciation has to come, which is 6. And one more adjustment they gave related to this about the warranty. The year-end provision for warranty has been estimated. So they estimated the warranty provision to be 75. Okay. And if I take warranty provision, I take the account. Opening balance 90, closing balance 75. So warranty provision, it's a liability. Okay. So if any expenses had been expended, what is the if at all they have given the adjustment. Warranty provision as per the trial balance is 90. Now what they have said, they want to year-end provision for warranty claim has been estimated at 75,000. Warranty costs are charged to administrative expenses. So they from 90 they want to keep it to 75. So definitely 15. They have reduced the provision by 15. Okay. So this has to go to administrative cost or expenses. So warranty cost. Just do the totaling of this. How much are you getting? 170 plus 6 minus 15.